quick review. And then we will go over some more of the financial statements because we've gotten up to part of the balance sheet. I don't think we even finished the balance sheet, right? Because I remember I went overtime, right?
Yeah.
Okay. So again, we are learning financial information and technology or accounting, however you want to look at it. And we talked about what accounting is. You basically need to keep track of all the different financial transactions, turn them into reports so that the people who need that information can know what's going on with the company's finances, right? I discussed how financial accounting is different from managerial accounting, which is the one where you provide financial statements primarily for people that are outside of the organization. Financial or managerial? Financial, correct. And managerial is where you make reports for the managers, right? Oh, jeez. Every time I make a little change to the screen for some reason, like I said, technology is not my friend today. I don't know why. Okay. And I explained GAAP. Does anybody remember what GAAP stands for? Generally Accepted Accounting Principles, which is brought to us by the Financial Accounting Standards Board. And again, some companies follow international standards from the International Accounting Standards Board. And I think in the future, there will be global standards for accounting because a lot of people invest in companies from different countries. So it would make sense that we had a standard way to do accounting worldwide. I talked about the difference between public and private accountants. If you do accounting only for your employer, so you help keep track of your employer's financial accounts, are you a private or public accountant? No takers on that one? Okay. How about if you do accounting for multiple clients? Are you a private or public accountant? Private. You're sick. I heard something over private. Heard private, but it's public. So if you do accounting only for one company, you're a private accountant. If you do it for multiple clients, you're a public accountant. Which I know might seem backwards depending on how you look at it, but that's, I think, the easiest way to remember the difference. So if you go to work for one of these big four accounting firms or even a smaller accounting firm, you'll be doing accounting for lots of different companies or individuals, and you'll be a public accountant. If you get certified and become a certified public accountant, you can charge more money. People who are CPAs can charge extra for their services because they have that certification. Then we talked about the accounting cycle, basically the process whereby we track all of the financial transactions. We have to categorize them and we document them in something called the journal, where we list all the transactions. But then we also have a ledger where we have individual accounts and we keep track of every transaction for that particular account. And then we take the balances for those accounts, we put them into what's called a trial balance, which has two columns. Anybody remember the names of those two columns? Debit and credit. You don't have to know that, but I did mention it the other day. So debits and credits. And then those debits and credits should balance, they should equal. And that's one way to just make sure that you're doing your accounting properly, because if they don't equal, then there's a mistake somewhere in your accounting records. Once you've gone through that process and made any necessary adjustments, you can then make your financial statements. And again, if these financial statements are going to be shared with people outside the organization, you have to follow generally accepted accounting principles, or GAAP, so that they know how you created these statements. So they know you followed certain standard procedures. And then those folks looking at those financial statements can use it to evaluate how your company is performing. They'll know how much money the company made, how much debt it might have, things like that. And then I mentioned that most accounting these days is done with software, and even to some degree, artificial intelligence is starting to get used more in accounting. A lot of it is automated. Then we got to the accounting equation, and the most common way to explain the accounting equation is as we see it here, assets equals liabilities plus equity. There are variations of that, but that is the basic concept. But what does that mean? What do we mean by the word assets? What are assets?
Is it personal or is it business?
Either.
It could be like houses.
Okay.
It could be cars if it's a business, right?
Okay, exactly.
It's you.
Things you own. Perfect. Right? So whether it's a business or individual, assets are things that you own. What do we mean by liabilities?
Things you need to pay.
Things you need to pay off. Yeah, debts. Exactly. And then equity is everything else. If we're talking about personal finance, your equity would be your net worth. So if you hear that term, oh, he's got a net worth of $10 million. It means if you take that person's assets and pay off all of their liabilities, what's left over is their net worth. But in business, we call that equity. And the equity has two parts. There's the part that came from the investors when they bought the stock or contributed money to the company in some way. And that is called contributed capital. But there's also equity that comes from the profits of the company. Now, where do profits come from? Sales. The more you sell your product or service, the more revenue you earn, and that increases your retained earnings. Increases your equity. So sales increase our profits, retained earnings, and equity. Expenses have the opposite effect. They decrease our retained earnings and our equity. And when the corporation decides to take some profits and give it back to the investors in the form of dividends, that also reduces the equity. Okay, so this is a fundamental concept in accounting. It's also the basis of the balance sheet. And I think we went through just the assets on the balance sheet. Let me double check my records here. And so I'm not going to go in detail here on the assets. Let's see. Okay. Now I need to check the slide number. Okay, so that is correct. We got through the assets, and that's as far as we got. So on the balance sheet, which follows that accounting equation, we start with assets, and we see on this particular date that's listed on the financial statement, what were the company's assets? And those are divided up into the current assets, which are the ones that we expect to use up within a year, and the long-term assets like equipment, furniture, building fixtures, intangible assets like a trademark we talked about already, right? And goodwill, I think I might have briefly explained, if you buy another company and you pay more than the value that that company has on paper, if you pay more than the net assets of that company, the extra that you pay is called goodwill. So that is also considered an asset. So when we talk about assets or things you own, they're not necessarily physical. They could also be non-physical things that have value. But if they are expected to last multiple years, or at least a year or longer, then they are not current assets, they are long-term assets. So this whole slide is all long-term assets. And we add it all up to get our total assets, everything the company owns, right? So that was as far as we got. Here we have liabilities and equity. Remember, the accounting equation tells us your assets equal your liabilities and your equity. So let's see if that is true. Now, this company has some current liabilities. Those would be debts that they have to pay within a year, because remember, the word current means basically within a year in accounting. By the way, I was just reading an article. I didn't read the whole article, but I was reading part of an article this morning. Jamie Dimon, the CEO of Chase, the biggest commercial bank in the United States, was saying that when they hire people, one thing they look for is people who understand the language of business, who have some background in accounting, which makes sense. They're a bank, right? It makes sense. But he expressly said that that is even more important to him than what you studied in college, if you understand the language of business accounting. So a lot of what you're being exposed to in this chapter is a different language, right? Just new terminology that you might not be used to. So current liabilities, again, would be debts that need to be paid off within a year. This would include something called accounts payable. This is money that you owe to your suppliers. Notes payable, those would be loans that you have to pay back within a year because they're current. You could also have long-term notes, but I don't see any here. Accrued expenses, this would be things like if you owe money to your workers for their paychecks, maybe you owe taxes that you haven't paid yet. Those would be accrued expenses or accrued liabilities. Oh yeah, here's also income taxes. And if you have some long-term debt that you need to pay off, but you need to pay some of it this year, that goes under this current liabilities. So even though it's a long-term debt, the portion you have to pay off this year is current. So just like we did with assets, you can add up all of the current portion. So here we have our current liabilities totaled up. They have one long-term liability. They've got a loan on some bakery equipment. And so if we add the current and the long-term liabilities, we get the total liabilities. You see, the math really is not hard in accounting. It's more understanding the words and the concepts. Then we get to the equity section. This company has issued $30,000 worth of stock. That means they collected $30,000 from investors and gave stock to those investors in return. And the company also has some retained earnings. Again, those are profits that they had earned previously, and they have retained those profits. They have not spent them. So that gives us our total equity. If we add the total liabilities to the total equity, we get this number 148,900, which, if we go back to the total assets, is the same number. So we see that our balance sheet balances. Our total assets equal to the total liabilities plus equity. If they didn't match, there would be a problem. It means we did something wrong somewhere because they have to match. So that is one of the more common financial statements, the balance sheet. It tells you as of that particular date how much the company owns, how much debt it has, and the equity or value. Oh, let's look at this one image here too. A way to think about this concept of equity. Have you ever heard the term home equity? If somebody buys a house, let's say the house costs $1 million, which would be like a little cottage here in Palm County, right? Maybe bigger in some areas, but you buy a $1 million house. Well, most of us don't have $1 million to pay for a house. But let's say you had saved up $100,000 as your down payment. You pay $100,000 and then you get a mortgage from the bank for the $900,000 that you didn't have. right? So now you've got $1 million house, but you also have $900,000 of debt. How much equity do you have in the house? 100,000. Because if you sold the house today, not considering any fees or anything like that, just if you sold the same house for $1 million, you'd have to pay 900,000 to the bank, and you'd only have 100,000 left. So your equity is the real value you have in the house. And that's the way to think of it for businesses too. If this business, this Delicious Desserts Incorporated, got sold, what is it worth? Well, one way to look at that would be you take everything that the company owns, its assets, pay off its liabilities, pay off all of the debts. What's left over is the equity. So when I say the equity really represents the value of the company, that's what I mean. Some purchasers might be willing to pay more than that, but that is, from just a simple calculation, that would be what the company is worth, the equity. Questions or comments? All right. Well, let's look at the income statement here. So there are 3 financial statements that we will be learning about. One, we've already completed, the balance sheet. Next is the income statement. And the income statement is also one of the most common financial statements. It tells us how much profit the company made or how much it lost. So another name for the income statement is the profit and loss statement. If you hear that out in the business world, out on the streets, sometimes they'll call it a profit and loss statement or a P&L statement, or sometimes just an income statement. And this is the basic formula for that. You take the revenue, which is the money the company earned from selling its products or services, subtract the expenses the company had, and then you get the profit, which also has different names. We'll just call it profit for now. That's the basic formula. Again, not too complicated. Revenue minus expenses equals your profit. Now, sometimes in accounting, we see these words gross and net. The easy way to think about that is gross is before any adjustments have been made, and net would be after adjustments have been made. For example, you know how if you buy something at the store, let's say you buy something at Target, and then for whatever reason, you decide you don't want it. And you go back to Target, hopefully they will let you return the item, right? Target's pretty good about that. Especially if you haven't opened it, especially if you have the receipt, especially if it was within a short period of time, they'll usually let you return it. So Target made a sale when you bought the item in the first place, but then you returned it. So that sale that they made is included in their gross sales. It would be everything that they sold. But then if you subtract everything that got returned, you end up with net sales. So this is part of the accounting process. You have to distinguish this and say, okay, we sold, I don't know, maybe Target last year, let's just say they sold $10 billion of product and $1 billion got returned. So the net sales would be $9 billion. Okay. And then you would take the net sales minus your expenses to get your gross profit. And we see that here, same bakery company. Now, one thing I'll point out here on the income statement is it's not as of a particular day, like the balance sheet. It's for a period of time. In fact, all the financial statements cover a period of time except the balance sheet. So in this case, we see this income statement is for a year. You could make an income statement that covered any period of time you wanted to. But companies typically do have annual income statements that show them how they did for the entire year. And that's what we see here. So we see that this bakery had $275,000 of gross sales. That's the total amount that they sold of all their bakery products. But they gave some discounts to some of their customers. Now, this type of discount is when you're selling to another business. And usually when you make a sale to a business, they don't pay you right away. But if they pay you quickly, you give them a discount. So that's what it's talking about here when it says sales discounts. Then we've got returns and allowances. Sometimes you make a sale and then your customer returns the product for some reason. So if you accept it back, that's a return. There might be other cases where the customer calls you up and says, hey, I'm not happy with this product. And you say, you know what, go ahead and keep it. I don't want you to return the product, but we're going to reduce how much you owe us. And that's called an allowance. Okay. So if you take your gross sales, subtract the discounts, the returns, and the allowances, we get to net sales. The next category we have, this is the first expense that we're looking at. Because remember, the basic formula is revenue. This is the net revenue here, minus the expenses. So the first expense is called cost of goods sold. What did it cost us to make those bakery products that we sold? Well, here's one way to figure that out. You say at the beginning of the year, we had $18,000 of product ready to be sold. Now, since it's the beginning of the year, that means we actually made that product last year, right? But we didn't sell it yet. So maybe we made it, these are bakery goods, they don't last very long. So maybe we made it like the last couple days of December and we didn't sell it yet. So on January 1st, we still have $18,000 of our bakery products. Then during this year, we spent this amount of money making more bakery products. So we add that to the beginning, and this is the total amount of bakery products we had available for sale at some point this year. And then if we subtract how much of our products we had available at the end of the year that we did not sell, that is our ending inventory. So we subtract that, and we get the cost of the goods that we sold, the cost of the products that we sold that year. Okay, so it's not a hard formula. Beginning inventory plus, God bless you, what you produced minus your ending inventory gives you your cost of goods sold. You just have to understand what the words mean, right? And the formula, not that hard to learn. Now, if we take our net sales minus the cost of the goods that we sold, we get our gross profit. We see that word gross again, right? You remember what I said gross means? Before adjustments. Excellent. Okay, so that tells you there's some adjustments coming. What adjustments? Well, other than the cost of making our product, we've got other sorts of expenses. So those are categorized as operating expenses. And then there are two subcategories. There are selling expenses, like salaries for our salespeople, advertising, and other selling expenses. Add all those together, we get our total selling expenses. Okay. Then the other category of other expenses, of operating expenses, is general and administrative. This would be stuff that's not related to selling, it's not related to manufacturing, it's more like corporate sort of costs, office kind of costs, like salaries for the professional and office staff members, utility expenses for our retail store, the office supplies, interest on any loans, insurance, rent, these expenses all together equal this. We add that to our selling expenses and we get our total operating expenses. We subtract that from that gross profit we had calculated. And that gives us, here it's called net profit before taxes. Then we take out taxes and we get our net profit. Again, the basic formula here is your revenue minus your expenses is your profit. So that's how to read an income statement. So now if you're thinking of investing in a company or going to work for a company, you can get your hand on their financial statements, which sometimes are published on their website. You can take a look and try to understand how profitable is this business? Where's their money going? How much debt do they have? You can understand that by looking at their balance sheet and their income statement. Any questions at this point? Okay. I think this might be a good place to pause because I know it's a lot of information to digest here. Yeah, let's do that. So we will get to cash flow statement after our grow activity. We will do that now. Okay, that was where we left off on the income statement. So the third and final financial statement that we will talk about is the statement of cash flows. This tells how much cash is flowing into and out of the company. Now, you might think that seems redundant because we already know how much the company sold and what its expenses were, right? So that kind of tells you how much money should be coming in and going out, but not necessarily. Because sometimes you make a sale to a customer, but they haven't paid you yet. So you can count it as a sale, but you don't have the cash. And sometimes you might incur an expense that you haven't paid for. So you count it as an expense, but it hasn't impacted your cash flow statement yet. So that's why we need a separate statement that tells us how much actual cash came in and went out. And it helps us make sure we don't run out of money. So that's the purpose of the statement of cash flows. And here's an example. Now, the statement of cash flows has 3 sections. There's cash flow related to the operations of the business. This would be where most of the cash flow is. It's from getting money from your customers, from selling your product, and then the cost of making your product or service. Okay, so that's your operating cash flow. Money related to your product or service. You can also have cash flow from investments. Companies can invest in other companies. They can invest in their own company. And so any money coming in or going out in relation to investments goes in that section. And then we've got cash flow from financing. If the company borrows money by taking out a loan, by issuing bonds to bondholders, or if the company sells stock, those would all be financing. And so any cash coming in or going out in relation to that would be cash from financing. So those are the 3 categories. Let's take a look here and see exactly what's going on the statement of cash flows. Now, again, the financial statement covers a period of time. So this statement of cash flows is for the entire year of this bakery. And there are 2 different ways to make your statement of cash flows. In this case, the way they're doing it, they're starting with the net income of the company. You're starting with the company's profits, which I just told you don't necessarily tell you how much cash you have, right? So if you start with the company's profits, you then have to make some adjustments to figure out the cash flow. So that's what they're doing here. They're saying, okay, the company had this much profit. They depreciated some of their long-term assets, and depreciation is how you figure out how much expense you can take for a long-term asset. Leave it at that. But depreciation does not involve cash. It's just an accounting calculation. So because that depreciation reduced our profit and there was no cash involved, and we're starting with profit, we have to add that depreciation back in. Okay? Again, what makes accounting hard is understanding these concepts, not the math. Then we had a decrease in accounts receivable. What the heck does that mean? It means that customers owed us money, but now they owe us less money, which means that they probably paid us, right? Which would generate cash. So we have to add that into our calculation. We have an increase in inventory. If we have more inventory now than we did last year, well, we must have bought some inventory, right? So that would decrease cash. Accounts payable, the money that we owe to our suppliers, has gone down. Okay, how did that happen? Well, we must have paid them. So again, that would decrease cash. Accrued expenses, things like money we owe to our workers, that has also gone down. Must have paid them as well. So you see, these are all the parentheses indicate a negative number. So we're subtracting these numbers. We're adding these numbers and subtracting the ones in parentheses. And that gives us the cash from operating activity. So that tells us for this year, we have $24,215 more cash because of these operating activities. Okay. Then we get to investment activities. It says here we had an increase in gross fixed assets. Okay. If we bought some, let's say, equipment or a vehicle for $5,000, well, we would have to pay for that, right? So that would cause cash to go down. Then we have cash flow from financing. Decrease in notes payable, that means we paid down some loans. That would require cash, and some other long-term debt, and that requires cash as well. So you see in investing activities and financing activities for this company, in both cases, you see the parentheses that tells you it's negative. So there was more cash going out in those areas than there was coming in. And now what we do, we take our cash that we got from operating activities, which was a positive number, subtract the cash that went out for investing, the cash that went out for financing, and we get the net change in cash. So we have $15,215 more cash at the end of this year than we did at the end of last year. So now you know how to read a cash flow statement. And again, if you're working for a company, you might want to see if their cash flow statement is available for you to look at. And you might have a better understanding of what it tells you than you did before. Right? So if you're an investor looking at this company, you're saying, okay, well, they're doing okay with their operating activities. Their cash is increasing. They spent some money on investing, that's fine. They're investing in the company. That's a good reason to spend some money. And they're paying down some debt. That's also a good reason to spend some money. I would say this company seems to be managing their cash pretty well. Any questions on the statement of cash flows? Okay. Then we get to financial ratios. I mentioned, I believe, on Monday that ratios are helpful. I know it might look like complicated, but they're helpful because looking at an entire financial statement, you really have to read it closely to understand what's going on. Financial ratios tell you the story very quickly. For example, we've got these different categories of ratios. Liquidity ratios tell you how liquid a company is. Okay, what does that mean? In financial terms, to be liquid means you can pay off your short-term debts. So we see under liquidity ratios, a current ratio. We know current means within a year, right? So the current ratio is simply calculated by taking the current assets, everything the company owns that planning to use within a year, or at least it could convert it to cash within a year. That would be the current assets. You divide it by the current liabilities, the debts it needs to pay that year, and you get a ratio, 1.4, which means the company's current assets are 1.4 times as much as their current liabilities. And the higher that number is, the better. With most ratios, you want a high number. There are some exceptions, but that's usually the case. And you could use that ratio to look at last year's performance versus this year's and see, did that ratio go up? If so, that's good. You could look at this company compared to another company and see which one has the better current ratio. There's the acid test or quick ratio that's similar. The only difference is you take out inventory in the calculation. And then we have net working capital. That involves the same two pieces of information, current assets and current liabilities, but instead of dividing, you subtract. So in this case, we get a dollar amount instead of just a ratio. This company has $23,050 more in current assets than in current liabilities. So that's money that they've got available this year to work with, and that's why it's called your working capital. So there we have some liquidity ratios. Any questions on those? We have another category, profitability ratios, to see how profitable a company is. So one example of that here is net profit margin. You take their profit, divide it by their sales. In this case, we got 11.9%. So that means the amount of profit that that company earned is equal to 11.9% of sales. Or another way to look at it, only 11.9% of what it sold, it actually kept as profit. The rest went to cover expenses. We have return on equity. It compares the profit of the company to how much equity it has. We have earnings per share. That is a very common one for the stock market. Investors pay a lot of attention to earnings per share. You take the profit of the company, technically minus the preferred dividends, but let's just say the profit of the company, divided by how many shares of common stock investors own. So what were the earnings of the company or the profits of the company per share of stock? Now, that doesn't mean that the investors get that much, but they want it to be as high as possible. In this case, $3.22. So the company earned $3.22 for every share of stock. And again, you want that number to be high. The higher the better, typically. Right? Then we have activity ratios. This would measure things like inventory. How quickly are we selling our inventory, right? Which would be an activity. So you could take the cost of goods sold, that was a calculation we saw on the income statement, and divide it by what was the average amount of inventory that you have. And the way we average things out, well, I say we, I'm not an accountant, but I teach accounting. So the way accountants average things out sometimes is they just take the beginning amount, the ending amount, they add them together and they divide by 2, and they call that an average. So that's what you do. You take your beginning inventory plus your ending inventory, You divide that by 2, and you call that your average inventory. And you divide that into your cost of goods sold, you get your inventory turnover ratio, which again, you want to be as high as possible. So in this case, it's 6.8. What that means is they sold 6.8 times as much as the average amount of inventory, which means they're roughly turning over their inventory about once every 2 months. So if you make a product today, that product will probably be sold within 2 months, which is okay. If you can turn over the inventory even faster, sell it within a month, that's better, because then you've got less inventories just sitting around collecting dust, right? Like DeAndre, you work in an environment where there's inventory that's perishable, right? If it goes bad, you got to throw it away. You got to turn that inventory over quickly. And the last ratio we'll look at here is a debt ratio. In this case, it takes the total liabilities of the company divided by the equity. You can see that that in this case comes out to 89%. That's kind of a high amount, I would say, of equity. In this case, you probably want it to be lower, less debt. But again, it depends. Debt does serve a purpose for companies. All right, so we've looked at different types of ratios. Efficiency ratios would be another name for these activity ratios. Also, there are value ratios that look at the value of that stock out in the stock market. All right. I mentioned already the benefit of using these ratios. If you're comparing 2 companies, and you know one has a higher EPS or earnings per share than the other, that quickly tells you that that company is earning more money per share of stock. You don't have to dig through their financial statement to try to figure that out, right? So these ratios simplify things for investors and analysts and anybody else that might be trying to understand what's going on with a particular company. What questions are out there regarding ratios or anything we've discussed up to this point? So I know this is not most exciting of our chapters. And a lot of it may not seem that relevant because if you're not planning to go into accounting, you're not planning to spend time trying to analyze and understand companies' financial performance, it's not that relevant for you. But if you are a business major, you will be taking accounting. And this gives you a preview of what it's going to be like. So imagine a whole semester like this, right? So if you end up taking my financial accounting course, it's going to be like this, right? So it's going to be very different from intro to business. It's going to be a lot of understanding these concepts, terminology, and doing some accounting mathematics. Okay, there was some major legislation that got passed in 2002. I don't know if I mentioned Enron in this course. There were a big financial scandal back around the time of the peak of the dot-com bubble, the tech bubble. There were a lot of companies out there that not only were not really good investments, there were some companies that were just outright committing fraud. And Enron was one of those companies. They were lying about their profits so that investors would buy their stock and push up the stock price, but it was all based on lies. They had set up this sophisticated accounting, actually creative accounting way to make it look like they were more profitable than they really were. And when it went to court, they said, well, GAAP, remember generally accepted accounting principles? They said, GAAP doesn't say we can't do what we did. And the judge said, it doesn't matter. You were clearly trying to deceive your investors. And so what you did is illegal And by the way, what they did had to do with setting up these offshore shell companies that they could funnel sales through to make it look like they sold more than they actually did. So GAAP didn't say specifically that that was a no-no, but they knew. They knew that they were trying to cheat the system, and they got caught. And the CEO and the CFO of Enron were both sentenced to jail, or at least the CEO would have gone to jail. He died before his jail term, but the CFO, Jeffrey Skilling, did go to jail. Now, that wasn't the only major corporate fraud at the time. There was WorldCom, there was a lot of fraud at Tyco. There were many companies that were committing fraud, and they were getting away with it for a long time. But when the dot-com bubble started to burst, in other words, when investors started to say, maybe these internet companies don't really make as much money as we thought that they were making. Maybe they're not really good investments. And they started to sell their investments in these tech companies. Well, the whole market started to crash. Not only the tech companies, but even other companies started to suffer. Their stock prices went down, started laying people off. And when the economy goes through a downturn like that, or when the stock market at least goes through a downturn, companies that were cheating the system oftentimes get exposed. They can't cheat anymore because they can't get any new investors to trick. And so they run out of money, and then everybody says what happened. And when the whistleblowers blow the whistle, and the FBI and IRS and other government agencies come in to see what was going on here, they see, oh, there was a bunch of fraud. So that's what happened with Enron, WorldCom, and other companies. Well, the Senate, the US Senate, which is part of Congress, passed a law. The law was written by these two senators, Sarbanes and Oxley. I don't know which one is which, but those are their pictures up there. They came up with this law that would make companies have to follow more strict procedures in their accounting. You would have to have an internal control system to prevent fraud in your company. You would have to audit that internal control system. The CEO and CFO would have to sign off on the financial statements so that if there was fraud in the financial statements, they couldn't say, oh, we didn't know what was going on. Oh, you signed off on it. You're accountable. Whistleblowers would be protected. Companies could be fined. Executives could be jailed. This was all part of this legislation to try to reduce fraud in corporations. And that was passed in 2002, in the wake of all this fraud that was going on. Well, historically, it was only 6 years later before we had our next financial crisis. Did I show you all the S&P 500 on Monday and how we had the dot-com bubble and then we had the housing bubble? Did I show you all that? No? No? Oh, that might have been my other class. Let's see. We have time. I'm going to show you just really quickly because it'll help illustrate what I'm talking about. The microphone's here, so let me just bring this over here with me and go like this. So the S&P 500 is a stock market index that basically tells us how the overall stock market is doing. Sorry. How am I doing trying to type and talk at the same time? It's not working well. S&P 500, there it is. Okay, that's what I'm looking for. Okay, so if we go to this index, which again, it goes up and down. It tells us how the overall stock market is doing. It's based on 500 corporations' stocks and the price of those 500 corporation stocks. So it's not perfect, but it generally does tell us the overall stock market. So we had this dot-com bubble that burst back here the year 2000. It was all these investors investing in internet companies. And so the stock market took off really quickly. We see in the late 90s. And then when investors started to get scared and realize a lot of these companies weren't really profitable, they started to pull their money out and the stock market went down. And then we had the housing bubble. And we also had Wall Street stock market investments related to housing that pushed the whole stock market up. So we saw another bubble, which burst pretty quickly at the end of 2008. It dropped like a rock. Okay. So in between, when Sarbanes-Oxley was passed here in 2002, it was only 6 years before we had another bubble, which also involved a lot of fraud. Unfortunately, there was a lot of fraud going on at that time, both in the housing market and in Wall Street. So Sarbanes-Oxley was helpful, but it did not fix the problem. So there was more legislation like the Dodd-Frank Act that got passed to further prevent fraud. But if you notice, remember I said these were bubbles. These were all-time peaks in the stock markets in the US. We reached about that peak again around 2013. But this time, it didn't come down. And in fact, look what's happened. It's gone up and up and up and up. We've had a couple dips here. Like this one was when COVID first hit, stock market freaked out, but then quickly recovered. And then we've had some others related to oil prices and Chinese tariffs and things like that. But we are pretty much at record highs. I mean, just recently, is that like in April? Just last month, we hit some record highs in the S&P 500. So if there was fraud during these two bubbles, is there fraud out there during this bubble? Which got to be a bubble, right? At some point, the stock market's going to have to come down. I would venture to guess, yes. There's probably still, despite the Sarbanes-Oxley Act, despite the Dodd-Frank Act and any other efforts to get fraud out of corporations and the stock market, I think there's still fraud. Okay, questions or comments? Speaking of fraud, looked at my phone just to check the time and I see a text. Guess who I am? Scammer.
Candyman.
Okay, the next topic, cloud computing and automation. So you know what the cloud is, I would imagine, right? It's when we store data on the internet instead of storing it on our devices. Well, that's how companies store their data these days. Because hard drives can crash, right? And hard drives can get hacked. So you're generally safer if your data is on the cloud, which really just means it's on some professionally managed computer that you access over the internet. So that's been a big trend. A lot of accounting is done that way now as well. Instead of downloading software to do accounting, people use things like TurboTax Online, QuickBooks Online, and other programs where you actually store your data somewhere on the cloud, and you even access the software over the cloud. I mentioned on Monday, there's been a ton of automation. Computers dramatically changed how we do accounting. You don't need people just sitting there writing in ledgers and journals or typing it on a typewriter. Now, computers do most of our accounting just automatically. So that frees up accountants, right? And you would think that we really don't need accountants anymore, but actually demand for accountants is very high. And I think that's because the supply is very low. A lot of people don't go into accounting because it's, it is math. It is a lot of legal concepts, actually. It is kind of dry. But From a career standpoint, from my perspective, it's a really good choice because of the demand that's out there and the pay that you can earn in accounting. All right, with our remaining time, with about 5 minutes left, we're going to match up these 8 learning objectives. Now, I know this is kind of cluttered. This over here is one image, these 3 circles. This is one image, these 3 squares. Here, the outer ring is one image and the inner ring is another image. So take a minute to look this all over and see what matches you can make. Okay. Starting with the first one, financial reports and who uses financial reports. Which image would you match up with that? Gus?
So is it the circle one, the blue one, the other circle?
You certainly could, because this is the process by which financial reports are made. And why do we follow this process? So that we can provide these reports to people outside the organization and they know how we came up with the numbers. So, okay, that's a good match. Number 2, public and private accountants. Match there. Daisy? Bottom right? Okay. So here we've got a company and we've got all different groups like, let's see, suppliers, customers, etc. If that is, let's say, one of the accounting firms, its customers would include any companies it's going to do accounting for, right? Okay, and number 3, the accounting cycle. What would be a good match there? Accounting cycle. Huh? Bottom left, the blue, or the inner circle? The big one? Okay, yeah, well, that technically is. Remember, this textbook said that there are 6 steps in the accounting cycle. When you take financial accounting, you'll learn there are 9 required steps and there's a 10th optional step. So, so that is a good choice there as well. How about the balance sheet? Okay, bottom right. Top right? Oh, perfect, yes. That is the accounting equation, which is the basis for the balance sheet. So I think that's a very good choice, Daisy. What about income statement? No takers on that one? Up left, okay. Yeah, so we got the gross profit and the net profit, right? That's what we find out from the income statement, how much profit we made. Then we have statement of cash flows. Top middle, okay. Yep, cash flow from operations, financing, and investing. Those again are the 3 areas of the cash flow statement. We have ratio analysis. Middle circle, okay, yeah, these are our different types of financial ratios that we learned about. And well, let's just see what images we did not use. Here's one that says certified public accountant, which again, that's the highest certification you can have as an accountant. And that's the choice a lot of people make if they're going to go into accounting. They get their bachelor's degree, they go for their CPA license, and then they're basically set. I mean, you could go on and get a master's, but you could have a great career just with a CPA license. What else did we not use? I guess we did use everything. So, so this here shows FinTech. FinTech stands for financial technology. That is a whole field of software designed to support finance. And you can see just how many different types of financial software and companies there are out there. So again, that process of automating accounting through software is one of the trends that will continue, I'm sure. So we have 2 minutes left, but since I kept you late last time, let's just call it even, okay? And have a good rest of the week. I'll see you on Monday.
Good weekend.
They like that too. Yeah, I'm gonna say he did this shit.